Holy shit, it's cold. What is up, guys? Little different format today. I want to talk a little bit about the markets. I'm actually headed to get a haircut at Modern Classics. Now, if you haven't been to Modern Classics, definitely check these guys out. They're probably one of the best barbershops in Charlotte. Donnie's a great guy, the owner. He's got two shops, one in South End, one in Plaza Midwood. Instagram's tagged right here. Check these guys out. I go to Tanner. Incredible barber. His Instagram's right here. But link below to check these guys. But let's get into the market. So what's happening, in the Charlotte real estate market right now? We just finished up 2024. It was a wild ride, right? You had the election. You had interest rates that went way up into the sevens. Pretty tumultuous, right? I mean, I'm not going to sit here and sugarcoat this one. This was, if you look at the number of closings, we were down, significantly down around the 2008 mark for number of closings here in Charlotte. But that's not necessarily the end of the world. It's not a bad thing. We're in a cycle right now, okay? And what is the cycle? The cycle is an environment of higher rates, okay? The rates of 2 and 3% are gone. COVID is gone. The consumer, I feel like now, has to get accustomed to rates in the 6.5, and even closer to 7. But what does this actually mean? Well, it's putting a big strain on affordability. And when I say affordability, what are we talking about? If you look at what happened in the last 4 years, and I think a lot of people I meet with don't really understand this to the full extent. And I just wanted to quickly touch on this. When COVID hit, the government turned the money printer on. And that wasn't free money, okay? That money, when they turned it on, the printer got issued in debt. And it typically gets issued in long-term debt. So 10-year plus treasuries and longer. So trillions of dollars get printed. Biggest we've ever seen in U.S. history. We've never seen debt get printed like this ever. And within a short period of time, right, inflation picked up rapidly. And then also you had interest rates that were rock bottom, went from 2 to 3%, and now we're up to almost 7. So you had a pretty big shock on both sides. Now, when inflation really kicked up, of course, it increased assets significantly, specifically real estate, okay, was one of them. Real estate in Charlotte has gone up astronomically. I've made videos on this. You can go back and check those out. But we've gone up in 4 years, a hockey stick, like many other areas of the country. But the consumer, okay, the actual buyer, or if you're a seller, the incomes needed to afford these homes have not kept up. So if you were working a job, which many of us do, and you get a 2 or 3% raise at your employer, you may have got over 4 years, let's just say you got an 8 or a 10% raise. That 10% wasn't nearly enough to keep up with how fast housing went up, which in Charlotte, in some areas, it went up 100%, maybe even more. So your 10% raise didn't keep up with how quickly the housing prices increase. And this is why this is important. Over the past, I would say, 50 years, if you look at the charts, real estate goes up typically 3 to 5% a year, which is about right in line with raises that were given out at these companies, in employers, and it stayed in line with inflation, okay? Now we've got what I would consider a major gap that got produced in the United States, in other areas, right? You got a major split. So where does this leave us, right? Well, I can just tell you, for those that are looking to buy, okay, specifically in Charlotte, the prices are not coming down. I know people like, hey, I don't know if the sale prices are going to come down, or are they going to crash? I read a statistic this morning. Sale prices would have to come down 38% to return to pre-pandemic affordability. 38%. That's never happened in U.S. history, okay? And it won't. Also, incomes would have needed to increase 60% to keep up with the current prices with affordability, which we all know we're not going to get a 60% raise. So what this means is real estate as an asset class, okay, will continue to appreciate probably quicker than we've seen in the past 50 years because of the housing shortage. And now, in my opinion, it has the value of the homes have increased significantly to the point where I think those that can afford it are going to benefit because they're not making enough of these houses. And guys, like it or not, the population is continuing to grow in the United States. It just is. We still don't have enough homes. If you look at the charts, we don't have enough houses for all these people. Now, some people may say, well, Mitch, they're building a bunch of apartments. A lot of us are just going to rent. Okay? I get it. Renting right now, in some cases, probably is a little bit less expensive. But if you look at if you look at the charts of how wealth was built in this country, real estate was the primary driver of wealth accumulation in the United States since the beginning of when it was founded. It was real estate. It was dirt. Okay, dirt. So that's where this gets pretty interesting when I look at and I talk to my clients. Right? Is even though the rates are high, I don't see the prices coming down. So let's just say you waited. Let's just say you wait. You wait for the prices to drop. And let's just say they don't. Let's just say they keep going. Let's say this year they go up another 5%. Well, that 5% on 450,000 is going to diminish your buying power significantly versus waiting for that rate to drop to say, if you're going to wait to say 5.5% or 5%, guys, we're a long way from that. And it probably won't happen for some time because of how screwed up the bond market has become, driven by the amount of money that was printed and the returns these bond investors are demanding, right? Rightfully so, with inflation. The Fed does not control the long-term rates. They don't. That is controlled by the open market, the bond market. And the bond market knows right now that inflation is still sticky in this country. It will be, which of course we're seeing even in the sale prices. I mean, again, look at the Charlotte real estate. Went up 8.4% in 2024 versus 23, okay? Even with these high rates, inflation is still sticky in the economy. The bond market knows this. That's what's going to hold these rates higher, I think, most of this year and going into next. So that's just something I wanted to talk about with everyone is look, if you're in the market to buy, I would certainly do so sooner than later, okay? Because Charlotte is still growing, and I've made videos on this as well, and it will continue to grow. We are, in my opinion, still one of the cities on the East Coast that's in its infancy compared to where I think it will go in the next 5-10 years.